at risk and uncertainty. All right, risk and uncertainty. So for risk and uncertainty, we need to understand what risk is. And do we have anyone who can tell us what a risk is? Yes, anyone? What do you understand by risk? So remember I said this is an interactive class, right? Let's imbibe the culture of contributing to the class. Someone is saying, oh, okay, not here. So let's all contribute to this class. Let's make it fun. Let's make it understandable. Okay? If you have any question, please don't wait for me to hand it before you now say, oh, there was a point I did not understand. Please, immediately you don't understand, call me back and we'll treat it like immediately. Okay? We'll treat it immediately. So that's what we have there. Now, risk and uncertainty. What do we understand by risk? What do we understand by risk? What is a risk? Yes, anybody, what is a risk? I believe risk is still not much of what do we call it? It's not much of performance management. It's still English, right? And I believe we've heard of risk before. So what do we understand by risk? Anybody?
All right, so let me just attempt on
Yes,
that.
please, go ahead.
All right, so what I understand by risk is more or less like an unpredictable action, an action that you're not sure of.
An action you are not sure of, okay. Any other person?
Okay,
Okay.
let me try.
Let me. Okay.
Okay, VIX
I
is.
can't hear that person. Someone is saying something, but I can't hear. Or is the person not talking to us?
Yes, I want to talk about. I can. Somebody is talking on the background.
Okay, go ahead, please, because I'm not sure. Probably she's not talking to us, but go ahead.
Okay. Well, okay. In my own understanding, I think VIX is possibly of something unpleasant will happen. That is
Say it again, sir.
like something. It's possible that something unpleasant will happen,
Okay. So
like something bad.
instead of using possibility, can we say probability?
Okay. Okay, you can say that as well.
Yeah.
Yes, ma'am.
Okay. Can you hear me? Hello? This is, from my understanding, when you're not sure of what will happen in the future,
Okay.
but you can still predict, like maybe like yeah, but under probability.
Okay.
Yes, sir.
Hello, sir.
So,
Can you hear me?
yes, I can hear you. Go ahead, sir.
Yes, sir. Risk is a probability that things might not go the way we have planned it.
Oh, I like that one too. So you guys are bringing in different ideas that can be combined together to make a single sentence. Do you understand? So risk is
Risk is
that
the probability. It's a probability that an event will
um
occur and have a negative impact or
okay. Okay, so someone has given us a textbook definition. What I was
Hello.
expecting before, right,
Hello.
was just your own idea. I just want to I just want to know what you know. I just want to see what you know apart from what we have in the textbook, right? Because it's easy for every one of us here to memorize the definition of
All
risk.
right, sir.
What is risk? Risk is very close to us now, right? But in actual sense, what do we understand by risk without having to memorize? Yeah, Mr. Michael, Mr.
Can
Sunday,
I say something?
your hands are up. Yes, please go
Hello.
ahead. Miss Favor, go ahead, please.
All right. I want to say, yeah, risk risk can be defined as damages that occur due to our negligence.
Damages. Is risk related to
Yeah,
damages
like
due to negligence?
okay, can I say unforeseen circumstances that occur as a result of our negligence?
As a result, Now, risk doesn't have to be because we are negligent. I don't know if you understand. Risk does not have to
Okay,
be
hello, sir. Can I
because.
say
Yeah, I
something?
do.
Yes, go
Yeah.
ahead, sir.
Hello, sir.
Yes, go ahead, please. We
So,
can hear you.
yeah, risk is the likelihood of an event may go unexpected, in which we have little or no information about the event.
Okay. So when you had the part of little or no information, then that is not risk. That is uncertainty. I don't know if you understand me, sir. Do you understand my point, sir?
Yes,
So when
yes,
we say information, information comes from lack of, I mean, when you say lack of information, then we are referring to uncertainty. Now, risk on its own is that something bad will happen, something unpleasant will happen, and that unpleasant thing will affect us, will prevent us from achieving our goals. Do you understand that, sir? That event that will happen will
yes, sir.
prevent us from
Yes.
achieving our objectives. That is risk. I don't know if anyone understands me there.
Okay.
Does anyone understand me?
Yes,
Please, sir,
sir.
can you yourself?
Yes.
Yes. So
So please, can you come again?
risk is a situation, is the probability that something will happen, and when that thing happens, we will not be able to achieve our objective. Do you understand? Now, we need to understand that risk can be in two ways. It can be positive, it can be negative. I think that one is in your SFM. SFM will tell you that no, risk doesn't have to be one way. It can also be two ways. Do you understand? Now, risk is that there is an outcome, there is possibility or probability that an outcome will occur, and that outcome will not be favorable. That is risk. Uncertainty is when we have insufficient information or unreliable information about what will happen in the future. Does that make any sense, please? Does it make any sense?
Yes.
Yes, sir.
Yes,
Yes.
sir.
So,
Yeah.
so we need to understand that the difference is there. All right. Risk is that something bad will happen, and when that thing happens, something will happen, whether bad or good. And when that thing happens, we will not be able to achieve our objectives. That is risk. Uncertainty is that we don't have enough information to determine what will happen in the future, to accurately estimate what will happen in the future. Do we get that? So that's risk and uncertainty. Please, I think I'll have to share my screen as well. And okay, let me share my screen so that you can see my notes. I have a note here. You'll get the notes from the center. Can you see my screen now, please? Can someone confirm you can see my screen?
Yes.
Yes, sir, we can.
Yes.
And
Yes.
Can
Okay,
see.
so that's it. Now, that's the nature of risk.
Yeah.
So, risk arises when there is insufficient or unreliable information about future events that leads to inaccurate estimate for future values. So, now, if for instance, I want to talk about what my sales for 2026 will be when I'm preparing my budget. Okay, now, what will be my sales? Uh, okay, we are planning on expansion. We'll be advertising our products, so we hope to get more customers. So because of that, we're expecting that our sales will go up by, let's say, 40%. Now, we don't have information about inflation of next year. We don't have a reliable information. Don't let me deceive you. if you rely on what this Bureau of Statistics (MBS), if you rely on what they are supplying you on inflation, you might be wrong. You might make a wrong business decision. All right, so that's, you have to be careful even when you are following them. I'm not saying they are not there. I'm not saying they are not good or they are not performing their duty. But in Nigeria, we know that everything has been politicized, right? That they only say what the government wants them to say. Well, that aside, so that's uncertainty when you don't have when you don't have sufficient information. Why risk itself is that outcomes are possible, but the probability of each can be estimated. So risk can be done statistically. In fact, basically, risk is done by statistics students. Those who study mathematics will understand risk better. Now, how do we reduce uncertainty? Now, you cannot eliminate uncertainty. You can only reduce it. And how do you do that? What's the problem of uncertainty in the first place? The main problem is unreliable information or insufficient information. So if you want to reduce uncertainty, then gather more reliable information. More. Okay? Now, if it is about a product, sales forecast can be, you can use historical method. You can use historical sales. Now, in life cycle costing, or let me say in the life cycle of a product, life cycle has to do with, I don't know if I'll be taking life cycle on this side, Brian. Now, life cycle has to do with from start to finish of a product. What do I mean by from start to finish? From the first time you launch the product into the market, which is the introduction, the first time you introduce the product into the market, up to the time where the product starts growing and then you start having more customers, your sales start increasing. We call it the growth stage. The first one is the introduction stage. Okay, then the growth stage is the business is growing, is going up, your sales is increasing. All right, your profit is also increasing. Do you understand? You are spending less on non-current assets. All right, now that is that. Then also, after the growth stage, whereby your sales keep increasing every year you're having 10% growth, 10% growth, it will get to a stage whereby your product cannot grow beyond the previous year. Do you understand? The previous year profit or the previous year sales will also be the current year sales. Do you understand? So that is it. Now, in such a situation, what do you need to do? You can use the information of the previous year to the current year. Now, while we are on that, let's quickly pick a product. I don't know any product that has been newly introduced to the market. Does anyone have any idea? It could be grocery, it could be asset, it could be non-current asset, it could be even a biscuit, it could be detergent, any product. If you know of any product that was newly introduced into the market, does anyone have any idea? Any idea from anyone? We can't think of anyone, right? Okay, what about a product that...
Splash.
Sorry?
Splash detergent.
Flash detergent. Okay, it's a new product,
Splash.
right?
Splash. Yes.
Splash. Okay.
Yes.
So now, splash detergents can be a new product that was introduced to the market. All right? Now, at the introductory stage, you'll be spending more costs and your sales will not be more. Why? Because you are new in the market. Okay? So that's it. Now, then when you are growing, your sales will be increasing. Do you have any product that is growing that people are asking for it these days? The product is just increasing in sales. Do you have anyone? It could be Indomie, it could be spaghetti, it could be food items, biscuit. I think currently
Biggie Cola.
Biggie Cola. No, Biggie Cola is out of market now. Do you still have Biggie Cola in the market? I think these Fabs biscuits, it's still increasing in the market. Some people said that it's been long we have it, but by
I think
pink
it should be
current
Sosa.
in Abuja here, sorry,
Sosa drink.
Sosa drink. Sosa drink is long, it's been long too, Sha. Sosa drink is over 5 years old. It's over 7 years. Well, maybe from the
Of
southwest, but I know
American
Sosa
cola,
drink
sir.
from the southwest. Sorry?
American cola, sir.
Okay. Now, all these products, they start increasing in sales. The demand for that product is increasing. Okay? That is a growth stage. Then also, we'll have a situation whereby the product has gotten to a mature stage. We call it maturity stage. That maturity stage, your sales for last year, if you look at it, if you compare it with your sales for this year, the difference might be just 1 million, 2 million, depending on the size of your business. The difference might be in thousands. Sometimes the difference might even be in hundreds. Do you understand? The difference between your last year's sales and this year's sales will now be constant. It will now be a mature state, a maturity stage. Now, that stage, you can use the information of the previous year to forecast the future. That is what we are saying here, that sales forecast can use historical data. Then, after using the historical data, you now adjust for trends and pricing. What do I mean by trends? Trend is that what is our inflation rate doing these days? Is it increasing or decreasing? If it is increasing, then consider the element of inflation when you are forecasting this time. Okay? Exchange rate, will it affect your business? Consider the element of exchange rate in your products. Then also, what has been the pricing over time? 5%, 5%, 5%, 5%, 7%, 10%, 2%. You need to look at all of this to reduce your uncertainty. Okay? Now, another thing is that if it is a new product, remember the first one is if it is an established product, a product which is already in the market. If it is a new product, then sales forecast can be difficult to achieve. Why? Because there is no benchmark. There is nothing you want to compare with. Okay? Now, for market research and focus groups, when you have a market research and focus groups, that can help you to reduce uncertainty. Why? These people can go into the market and obtain the core information, the information that you need. Do you understand? So that's it. Now, that's about reducing uncertainty. Okay? Now, how do we deal with risk and uncertainty when we are making decisions? Now, as a manager, you need to evaluate your expected incremental cost. What do we mean by this? What is an incremental cost, if I can ask? If I may ask us, what is an incremental cost?
Additional cost.
Yes, additional cost. Another name for it?
Marginal cost.
Marginal cost.
Marginal.
Okay, everyone is just using. Okay, marginal cost.
Oh, differential cost.
Incremental fixed cost.
Differential
Incremental
cost.
fixed cost.
Incremental fixed cost. It
Fixed
doesn't have to
cost.
be fixed cost alone. It can be variable cost. Okay? It can be a variable cost. Now, incremental cost is an additional cost incurred. So when someone called it a marginal cost earlier, yes, you are right. An incremental cost, you are right. Whatever name you have called it earlier, you are right. Now, if there is an additional cost that will be incurred, now let's look at this class for instance. In this class, do you know the additional cost? Do you know the cost for this class? Your incremental cost. You know you can be on WhatsApp group and not incur any other additional cost except your data, the data that you lose whenever a message comes into your phone, right? Now, your additional cost for this class is that if you have budgeted, let's say 1 gig for this class, 2 hours, 1 gig. If I extend the class from 2 hours to 2 hours 30 minutes, it means you will incur additional megabyte, right? That additional megabyte is an incremental cost. Now you can have an expected incremental cost. You can always expect it when you are forecasting. Do you understand? Because when you want to make a decision, you need to ensure that all those things that you did not have before, you had them. Is someone trying to say something? Okay, so that's that. Then also, if you're expecting any additional revenue, do you understand now? So let's say, for instance, expected, and don't forget your what do we call it? Prudence concept. The prudence concept. Can someone remind us prudence concept? Does anyone know prudence concept? Prudence.
The
He said
concept
that
is that
profits
what
should not be
should be
anticipated.
when actually uh,
Someone wants to try?
so can I
Please
go
don't
on?
know.
I said prudency concept said, according to the prudency concept, profit should not be anticipated.
Is that all? I actually think there is more to it. Prudence concept is more than that.
So sorry, sir.
Okay, go
I
ahead.
don't know if I can still remember. I don't know if I can still remember, but I remember prudency concept states that profit should not be overstated and cost should not be understated.
You can do that in
Sister, let
another
me
way.
let me let me
Provision
just
should be
what I
made for
can remember.
possible losses.
So it also talks about judgment, like your own personal judgment in trying to value items of transaction.
Okay, sir, the concept says that we should apply caution when stating our profit. We should do it in a way that our judgment doesn't cloud the fact that we overstate it or we understate it. So there should be caution.
So I have taken everything everyone has said. Okay, now prudence concept is that you need to be careful when you are realizing, when you are recording your revenue. You need to be careful. That is, revenue should be recorded when there is certainty or when it has been received, not only when it is earned. But all known liabilities must be recorded. All known liabilities must be recorded, whether you have paid or not. Okay, whether you have paid or not, record all your expenses and your liabilities. But your revenue, you need to be very careful, you need to be prudent so that you don't overestimate your revenue or underestimate your expenses. So that is it. All right, now you need to ensure that your incremental cost, you add it to it, and don't just expect any revenue. But if there is any expected revenue too, that you know that there is certainty, for instance, our sales, you need to be very careful at that. But of course, if there is any incremental revenue, you need to document it as well. And also, your profit has to be documented. So you can evaluate all these three things: your cost, your revenue, and your profit. Then also, you need to you need to evaluate any of these things that is associated with risk and uncertainty. Are we together, please? Are we together?
Yes, sir.
Yes, sir. Yes.
Then
Yes, yes.
also, you as a manager, management attitude towards risk should also be understood. What do we mean by attitude toward risk? Attitude towards risk, you can call it risk preference. You can also call it risk appetite. I like calling it risk appetite a lot. Why? Because appetite is what? If I want to eat, Abby, and how much I can eat. Some people tell you, I don't have appetite, so I'll just eat small.
Appetite is eagerness.
Your eagerness. Are we there, please?
Yes,
Are we
sir.
there?
Yes, sir.
Okay. So your appetite,
Yes, sir, we are here.
your risk appetite, your risk preference, your attitude towards risk, not just your own, the management, right? Now, what is the management's attitude towards risk? That is, what is the level of risk you can take? So let me break it down. You see, there are some of us like me, eh? I hate taking risk. That is why I cannot do MMM. Do you understand? Do you understand?
Yes, sir.
I hate taking risk. So my risk appetite is very low. I don't know how to take risk. My risk appetite is very, 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 very low. Now, if you have people like me as shareholders or as managers, it means that there are so many projects we will not want to embark on. So you need to understand the risk appetite. Okay? So that's it. And also, you see that risk appetite, when you understand what my risk appetite is, or your own, even your own personal risk appetite, it will influence your decision. All right? Now, for instance, now, I can take a project that I know that the returns will start coming in 2-3 years time. So someone like me, I'll prefer, when I'm appraising my investment, I'll prefer to go by payback period. And if I'm going by payback period, I'll take the shortest period. Is that not what payback period is? Do you remember payback period under investment appraisal?
Yes, sir.
So
Yes,
payback
sir.
period now might be good for me. So it will influence your decision when you are dealing with risk and uncertainty, when you are making decision. Okay? Then also, we need to understand that risk cannot be completely removed, but it can be analyzed and assessed for acceptability. Okay?
Yes,
I
sir.
don't now, risk cannot be completely removed. Now let me ask you a question. In this class, right, you that you have come to write ICANN, what do you think is your risk?
Mix of failure or pass
Failure, not
or
pass.
pass. No. A
So,
mix of failure.
sorry,
Yes,
So
sorry,
mix
sir.
of failure.
if it is two ways, then you can say that
Hello,
either you
sir.
fail or you pass. Yes, sir, I can hear you.
Sorry. From my own understanding, there are many risks that associate with me writing ICANN, and one of them is um, if somebody, if there are two possible outcomes, either pass or fail. But in a situation whereby if I failed, that means the time I spent reading, preparing, listening for classes,
That's
the
what you
money I
lose.
invested would go. Yes.
Yes.
So that's make it risk. So that's why it has to be. Though I usually take calculated risk. I don't take accidental risk. I take
Okay.
calculated risk. So I have to do
Now,
something. I will calculate the risk and the worst situation.
so okay, now the risk is either you pass or you fail, right? Now, what do you do or what have you done in order to reduce this risk? You know that you can't completely remove it that anyhow, I'll pass. I don't know if you understand me.
Yes, yes,
You
yes.
can't
It's not
completely
possible.
say that anyhow, it's sure for me, die. I
It's
don't
not
pass this.
possible.
Right? Like
Yes,
you
sir.
can't say that anyhow, I don't pass this one. Do you understand?
Yes,
Yes,
sir.
sir.
So that's it. Now, we now need to look at what is your risk assessment. You need to assess it. So I'm sure you have assessed it that I can know in my assessment I cannot pass I can except I attend class. Oh. And that's why you are here. Right? That is you assessing risk. Okay? Now, you cannot remove that risk, but you can analyze it and assess it. So because you analyze and you assess it, that once I come to class, then I can take the risk of writing I can. Do you understand? Okay, now let's look at risk preferences. We'll still talk more on that, but I don't want us to deviate from what we have here. Let's look at risk preferences. So risk preferences can be a risk-averted person like me. Okay, we that we prefer a lower risk and we only accept risk, more risk for higher justified returns. Unless there is a reason for me to take it. Me, I'm not taking no. I'm not taking the risk. Oh. Please hold on a second, please. Please, I need you to give me 1 second. Hello, sir. Yeah, me, Lonson. What do you think? Yeah, sorry, please. I hope you can hear me.
Yes, sir, we can hear you.
Okay.
I
So
can hear you. Can hear you.
that is a risk. Okay, you have calculated it. So someone like me, I will only take a lower risk. If I want to go for a higher risk, I must be very sure that what will come from it is worth it and is worth very much more than what it is. Okay, are we there? Are we there? Hello? Are we there, please? Is
Is
anyone there?
anybody here?
But can you hear me?
Yes, it
Yes,
seems
sir.
the network is bad.
Okay, but
Maybe
can you
we
hear
will
me now?
rejoin.
Can you hear me now?
We can hear you, sir.
Okay, now another thing we have is risk neutral, and this risk neutral focuses only expected returns. They don't care about the risk. There are some people, they don't care about the risk. Is there money from it? Yes. So those people can do MMM. Do you get? So they don't care about. Oh, someone is saying they can't hear me. Oh, please, I need you all to confirm that you can hear me, please. I need everyone to confirm that they can hear me. Can you hear me?
Yes, we can hear you now.
Yes,
You
sir,
wanted
we
to
can
hear
hear
me
you.
before.
Yes, sir. Hey,
You guys can go. I sent a message already. You can go, please. Can you hear me, please? Can you all hear me now?
Yes,
Yes,
sir.
yes, we can hear you, sir.
Yes,
You
sir, we
wanted to
can
hear me
hear
before.
you.
yes, sir.
Hey.
Yes,
Sorry about
hearing
that.
Yes,
you.
sir.
Okay. So I will start from where I stopped again. So I was talking about risk averse, and I said a risk averse person or a risk averted person like me is someone who will only take a lower risk. All right, but I will go for a higher risk if the returns justifies it. All right, yes, that is it. Then that's why, like I said, someone like me will not go for MMM, will not do MMM. We have someone who are some people who are risk neutral. They don't care about the risk. They only focus on the expected return. Will this thing give me money? Yes, then they are going for it. They don't care whether it is legit or illegitimate, whether it's a Ponzi scheme or a legitimate business. They don't care. So far, it will give them a return. They are going for it. All right. Then we have some people who are intentionally willing to accept more risk for the chance of higher returns. Anyhow, any risk at all. So far, if you bring money, just bring and come, bring the deal. Okay, that's that about them. They don't care, and managers are usually assumed to be risk averse. Managers, they are usually assumed that they cannot take risk. Why? There's a reason for it though. You would have enjoyed the reason if there was CSMA, but there's no CSMA again. But managers will not want to take risk. Why? Because if I take a risk and I venture into an investment, I embark on an investment that will give me money, that will start paying me after 5 years. As a manager, who told you I want to spend 5 years in your company? So because I'm not even sure I want to spend 2 years in your company itself, I will not go for a project that will take 5 years before the returns start coming in. Because it will affect my annual returns too. Do you understand? So that is it. So managers are usually assumed to be risk averse. Now, please, this class will end at 10 o'clock. This class will end at 10 o'clock. And like I discussed with the management, you might need to reschedule the time as well. Okay? So that's just by the side. Now, expected values. Expected values. Please, do we have any question before I move on, please? Do we have any questions so far?
Sorry, sir. Hello, sir.
Yeah?
Sir, please, is there any difference between risk neutral and risk seeking?
Risk neutral and what?
Risk seeking.
Yes, there's a difference. So the risk seekers take more risk than the risk neutral. Do you understand? The risk seekers, they take more risk. They go for higher risk than the risk neutral. The risk neutral, many of us here are risk neutral, even me. When it comes to examination, I am risk neutral. When it comes to going for school exams or participating in school, you know that we coming to school, you writing ICANN is a risk. Abi? Yes, the labor market is requesting for chartered accountants. But who told you that there is one job waiting for you outside? Except you have a job waiting for you outside. It means that once you are done, you want to get a job. It's not like you have a job already waiting for you. Are we there? Can we hear me?
Sir.
Yes,
sir,
sir.
we can
Yes,
hear
sir.
you.
So we come
Yes,
to
sir,
school,
we are here.
and at the end of the day, we don't only come for ICANN. We still do what? We go for masters. Even when they told us that education has come. Do you understand? Many of us we still go for ICANN. Even when they told us education is a scam. Are we there?
We are here, we are here, we are
So that's why I
Yes, sir.
said that even coming to class is a risk. Writing ICANN is a risk. But we are risk averted because we are risk neutral because we know that it will definitely give us a better return. Okay, so that's it. Now, shall we proceed now?
Yes, sir.
Okay.
Yes, sir.
Okay. Now, expected values. Expected values has to do with the possible returns, the possible outcome of a project. Then you find the weighted average of that project. Okay? Weighted average of such a project. All right? So you involve risk by calculating the weighted average of a possible outcome. Okay, that's what we have there. And here, I don't want to be using this. So we have it as the expected value will be the summation. This is summation. Let me clear this. Summation of your P is the probability, while your X is the value of outcome. P is the probability and X is the outcome. For instance, if I said I'm giving you 5,000 naira today, okay, now let's say the probability that I'll give you 5,000 naira is 50%. The probability that I'll give you 10,000 naira is 20%. And the probability that I'll give you 2,000 naira is 30%. So probably I'm saying that if I ask you a question, if you get the question rightly, then I'll give you, if you get it correctly, like just normal getting it correctly, I'll give you 5,000. If you impress me in your answer, right, I'll give you, like, you impress me more, like I enjoyed your answer, then I'll give you 10,000. But if you do not get it very well, okay, then I'll give you what? 2,000. So that is what we mean here. Do you understand? Now, what is that? If I ask you for the expected value now, let me see if I can open an Excel sheet. Let me see if I can open an Excel sheet and then show you what I just said on an Excel sheet. Okay. Can you see my Excel sheet now? Can you
Yes,
see my
sir.
Excel sheet?
Yes, sir.
Yes, sir.
Yes, we can.
Okay. So I said if I'll give you 5,000, right? With a probability of how much? What's the probability? Hello?
50%.
50%,
50%.
right? Okay.
50%.
So probability is 50%. Then probability that I'll give you how much again? 10,000
10,000.
is
Then
at what percentage?
30%.
20%.
30%.
20.
20%.
And then that I will
Okay.
give you how much? 2,000 is at what percentage? 30.
30%.
30%.
30%.
Right? Now,
Yeah.
expected value is that EV. Expected value is that 50% times 5,000. This times
5,000.
this. Do you understand? Then
Mm.
20% times 10,000 and 30% times 2,000. Do you understand? What's the total? So the total is your total expected value. This 5,100 is your what? Expected value.
Value.
Do you understand? So that's
Yes,
why I
sir.
said that expected value is what? Summation of my probability times
And
my
value
value,
of
which is the
outcome.
amount. So amount here is the X. Are we together, please? So the amount here is the X. That's the expected value. Okay? So that's the expected value. Then that's that. Now, let me close this. Shall we proceed, please?
Yes.
Shall we proceed, please?
Yes, sir.
So I believe I've
Yes, sir.
explained expected value now.
Please go ahead.
Okay. Now,
Fire answer.
the decision rule. The decision rule when you are working with expected value is that you choose the option with the highest expected value, highest expected profit if it is in profit, or highest expected revenue. But if it is cost or expenses or liability, then you go for the lowest expected cost. Okay? Are you there? Eh?
Yes, sir. Well, yes.
Okay. Now, that's that. The advantage of expected value is that it considers both outcome values and the probabilities. Are we there? It considers. Hello, can that person mute? It considers both what? It considers both the outcome values and the probability. Okay? And that's what we have there. Shall we proceed, please? Shall we proceed?
Yes,
I'll
sir.
take
We
it
are
as a
with you.
yes.
Yes, sir. Proceed.
Okay. Now, yes, I can hear you. So that's what we mean by weighted average of all possible outcomes. Weighted average. You see this my Excel sheet. Everything I've done here, the weighted average is this of all the possible outcomes. Okay? So that is weighted average. The 5,100 is the weighted average. All right? Are we there? So that's it. Now, then it incorporates probabilities and recognizes risk in decisions. Okay? So probability is there. Your decision in risk is also there. Okay? Now, another thing is that it is simple. Any complex choice, any complex decision, it can easily simplify it for you. Do you understand? So that's what it does. Now, it can simplify complex choices into a single comparable figure, thereby making your decision easier. But the problem there, the disadvantage with it is that probabilities accurately can be difficult. Estimating an accurate probability can be difficult. You can't be too sure. It's a probability. Now the question is this. Let's look at this, my illustration again. What is the probability that, how did I arrive at this 50%? How did I arrive at the probability of 50%? Shebi is my probability, not your own. Me, I just decided on my own that 50%. Do you understand? So that's the disadvantage with it. Okay? Are we there?
Yes, sir.
So that's the disadvantage of this particular expected value. Now, another thing is that it is often not an actual outcome. It's just an average. Okay? It's not an actual outcome. Do you understand? Now, another thing is that it is not suitable for a one-time decision, as the average may never occur. It's not good for one-time decision making, because that average, you might not get it. Do you understand?
Yes, sir.
Then it does not show the spread or range of possible outcome. So which means it doesn't really represent full risk. Okay? That is it. It doesn't really represent full risk. Any question?
Yes, sir. Please, can you explain? It's not suitable for one-time decision. I don't quite understand that aspect. Thank you.
So yes, a one-time decision. A project of one time, you've not done it before, or you want to make a decision about a contract, a one-off contract. Okay, now you can't use this estimated value, expected value, to make a one-off contract. A one-off contract is that someone just gave you a contract, all right? And that contract is not like once you complete this, you get another one. Do you understand? So you can't really, because if it is one-off, where will you get that probability from? I don't know where this echo is coming from, please. I think that person should mute. So where will you get your probability from? But you will have more experience if you have been using, if you have been doing a project consistently. Then it is reasonable for you to say that, okay, bad as bad. At least we've done this one, You have that experience. Okay, so that's what we are saying here. Does that explain it now?
Thank you, sir. Yes, sir.
Okay. Now, when estimated value or expected value is reliable for decision making, you can use it when probabilities are reasonably accurate. Okay? And when decisions involve repeated outcomes, that is like monthly sales. So my monthly sales now, I can use that. Last month we sold this. 2 months ago there was a problem, so we couldn't sell well. But last month we sold very well. Then again, in the month of July, we usually sell more. Okay, and so we are expecting more sales. And in August, I can't say. There is usually something, so we don't usually sell well. Or we usually have more sales in August because it's our customer service week. It's just that we will not have much profit because most of our goods we go out on, let's say, on discounts. Then in November also, we'll be having a Black Friday. So because of that, we don't have much sales. Now, you already have an idea of what will affect your sales in all those months. You can use estimated value or expected value, but you will not use it for a one-off contract, a one-off project. Okay? Are we there?
Yes, sir.
So that's it. Now, decision tree. We'll be ending our class tonight on decision tree. So decision tree, no, we still have another one. But since it's theoretical, so we can always go for it. Now, decision tree is a tree. We call it a tree because it has branches. Okay? We have branches, and what is that branch? Different decision making. Okay? Different decisions to be made. Are we there, please?
Yes, sir.
Are we there?
Yes, sir.
Yes.
Yes.
Okay.
Yes, sir.
Yes, sir.
So what do you
Yes,
use
sir. We are with you.
decision tree for? When you have to make decisions at different stages, at different branches, at multiple stages, then you use decision tree. Now, for those of us who did QT or QA, quantitative technique, if you started with ATS, quantitative technique, we started with foundation. No, there's no quantitative technique in foundation. In your higher institution, if you did quantitative techniques, Mr. Ibrahim can testify to this. Okay, so if you did quantitative techniques in your higher institution, right? You must have done decision tree, and there is also another one which is networking. All right, these are business decision models. We use them for making decisions. Do you understand? We use them for making decisions. Now, you see that business decision tree. If at every stage you need to make decision, for instance, now, let's say that I want to develop a project, or I want to go into a project. I want to go into a business. If I go into this business, I have two decisions. Number one decision is that I go into the project and invest my money in that project. The second decision is that I don't invest. I keep my money in the bank. I need to make decision on that one, Abby. I need to make decision whether to keep my money in the bank or invest it. Am I right? Am I
Yes.
right,
Yes.
please?
Yes.
That's number one decision.
You're
Now
right.
let's say I made the decision that I want to invest in the project. If I invest in the project, two things are involved. Is it that the business makes more profit? Is it that the business makes profit or there is a loss? That's another decision, Abby. Is it that there is a
Yeah.
profit or there is a loss, right?
Yeah.
Now, if there is a profit, is it that I make 100,000 or I make 500,000? If there is a loss, is either I don't lose anything, I'm at 0 naira, or I lose another 50,000. Now, when there is a profit, there's a decision there. Is either I go for 100,000 or I go for 500,000. Under that profit, I'm still coming to the loss. So, under that profit, probability that I'll make a profit of 100,000 is about 70%. Probability that I'll make a profit of 500,000 is 30%. Now, you see, when I'm adding percentage to it like that, it means that the percentage multiplied by that percentage is probability, right? The percentage multiplied by the outcome will give me the expected value. Am I right?
Yes.
So, which means under my profits, I have two decisions there, and now they have expected value there, right? So, we now say 500,000 times 30% probability, 100,000 times 70% probability. Am I right?
Yes,
Now,
sir.
let me come back to the loss. Under the loss, the probability that I will make a loss of 0 naira, that is no profit, no loss, equilibrium, is about 90%. And the probability that I will lose additional 50,000 is about 10%. It means 90% times 0 naira plus what? People cannot do, you guys are not doing complex account. Complex account without a pen. All these things will be done. When we get to the calculations, you will see them. Do you understand? It's not like we don't have them. When we get to the calculation, you will see. Let me see if I can show you from the Icon Study Pack. Now, as I was saying it, I was expecting someone to be following me like Twitter, like X, but nobody's following me. All right, and it's normal like that. Don't mind me. The school where I attended, me and Mr. Ibrahim, we used to have a lecturer. Okay, by the way, we attended the same higher institution. We have a lecturer. That lecturer will sit on the first table, and the person will take us financial statement, income statement, and statement of financial position. While on the seat, the woman will not write anything on the board, and that balance sheet must balance. She will not write anything, and she will not even give you time to write. She will be saying it offhand, you'll be following her offhand. You are debiting this one, you are crediting this one, and you are using your head to follow it. Okay, I already have this item there. The non-current asset we had earlier was 50,000. Then the current asset, the inventory was 10,000. You'll be using your head to follow it. As you are following it, you are adding it. So that's the lecturer who taught us. That's why it feels like I can be doing things like this and I will not be affected. Do you understand? So let me share something like this decision tree. Can you see my screen now?
Yes.
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 So this is a decision tree. This is the starting point. Now look at this question. A company is considering whether to invest in a project costing 12,000. All right? Which has an 80% chance of being successfully developed. So if I invest 12,000 now, it means that it will be developed, right? So this is the answer here. If it is developed, I have 12,000. Is either it develops or it does not develop. Right? That's the first decision. Is either I develop the project or I don't develop. Now, it will cost me 12,000. That's why we have it in brackets. Can you see that? Can you see that, please?
Yes, sir. We are
If
seeing
you
Yes.
could see,
Yes.
right? That's why it's in brackets. Now, if it is successful, it has an 80% chance of being successfully developed, which means if it is developed, there is 80% success, 20% unsuccessful. You can see that they are silent about the remaining 20% unsuccessful. What's the opposite of successful? Unsuccessful. So if
so.
80% takes successful, it means that the remaining 20% will take unsuccessful, right? Now the question can go further. If it is developed successfully, the profit from the project will depend on whether the economic conditions are good or poor. Now, which means under this successful, there is still more, right? And you will see them down here, successful. If it is successful, if it is good, you will get 50,000 naira profit at 0.6%, probability of 60%, right? 0.6 or 60%. Now let's come down here. Successful is divided into two. If there is a profit, you will have a profit of 50,000 naira at what? 0.6. But if it is
0.6.
bad, under
You have a
successful
loss.
though, if it is bad, it will be a loss of 20,000 and the probability is 40%. So this is it.
0.4. 40.
This is it here. 0.4 times 20,000. Do you understand now?
Yes, sir.
Now, at
Yes,
each
sir.
of these points, I can say that 50,000 times 0.6 will give me what? 30,000. Are you using calculator?
On it, sir.
Somebody is pressing calculator.
30,000.
So it's
30,000,
30,000. It
right?
doesn't. It's 30,000.
Okay.
60% of 50,000.
30,000, right?
Yes,
Yes.
sir.
30,000.
Yeah.
See, it's very simple. 5 times 6, 30. This 0.6 will nullify this 10. So 5 times 6 is 30. Do you understand? This one is 60%. But let's leave that. Just use your calculator. Don't do it offhand, please. Don't be like me. So 5 times 6 is that you make a profit of 30,000. But if it is a loss, it will be 4,000. I mean 4%, 40% times 20,000, which is what?
8,000.
8,000.
8. Abi?
Yes.
That's
8,000.
8,000. So 8,000 loss. Abi? Now let's
Yes.
come down
Yes.
to see. So which is my expected value is 30,000 plus minus 8,000, Abi. 30,000 plus minus 8,000 because this times this is minus, Abi. So
Yes, sir.
30,000 minus 8,000 will give me what? 22,000. So that's how they got 22,000 naira here. Do we understand?
Yes.
And
Yeah.
that is at point C. Do we understand? Now, at point B, whatever you get here, this 22,000, you bring it back to your point B. So you can see at point B you have 0.8 times 22,000, which is 80% success and 20% unsuccessful. 0.8 of 22,000 plus 0.2 of 0. Why? Because if it is unsuccessful, then it is 0. Only the successful is the one taking this 22,000. Abi? Shebi, only successful is the one taking this 22,000.
Yes.
Yeah.
Abi? So whatever
Yes.
comes out of this point will be multiplied by 0.8. And it being this unsuccessful extent, we can also multiply it backward. So that's it. That's why your 0.2 is multiplied by 0. So 80% of 22,000 is 17,600. That's a decision tree. Are we together, please?
Yes, sir.
So that's it. Any question? Any question? Now, that is for point B. When you go this 17,600, take it back to point A. Your point A is a loss of 12,000, which is a cost. Abi? Now, that cost is that the meaning is that this 17,600 is your profit. Remove your cost of 12,000 from it. What do you have?
5,600.
5,000.
So which means you will have a profit.
5,000.
If you invest 12,000, you have a gain or a profit of 5,600. Or don't proceed at all. Keep your money in the bank. Don't develop. Do you understand? So you now make a decision on which one is better. Is it for me to invest my money or keep the money in the bank? That you can see that at every point, point A, point B, point C, we have to make a decision. And one decision is different from another. Do you get it, please? One decision is different from another. So that is what we use decision tree for. Okay? Then also, a decision tree has decision points where choices are made. Outcome point is where expected values are calculated. Trees are drawn from roots, which is from the start. This A, the A here is the start, Abi, and you can see that this root, this one is represented with a box. What do you call this? I say triangle. Square.
Square.
Abi, so this your root will start with a square, while the rest will be represented with a circle. Okay, and that's how to draw a decision tree. So they are started from the root, which is the start, and the branches or outcomes are analyzed backward. You can see we started analyzing from C, Abi, from C back to B back to A, right? So that's the information you have there. Please, I hope I'm not rushing this class. Am I rushing this class?
No, sir.
No.
Am I too fast?
No, sir.
No, sir. No, you are doing well.
Shall we proceed?
Yes, sir.
Yes, sir.
Yes.
Yes, sir.
Yes, sir.
Now, value of information. So when we say to calculate the value of an information, then we'll be looking at whether it is a perfect information or an imperfect information. Okay, so how do we get the value of information? Now, for a perfect information, value of perfect information. Now, for perfect information, you need to know the outcomes with certainty. And the value of perfect information is the maximum amount you would pay to remove uncertainty entirely. That is, if you want a perfect information, what is the maximum amount you will pay? For instance, if you need a legitimate information, like information that, trust me, is legit, like they should check it anywhere, confirmed, how much can you pay? Remember, it's the amounts you can pay that will determine the amount of information you can get to. Some people, some people sell information. That's their own livelihood. They sell information, right? So what's the maximum amount you can pay in order to remove all forms of uncertainty? Okay? And then we'll be looking at what is the expected value without perfect information and what is the expected value with perfect information. Okay? So you will add the two together. The expected value without perfect information and the expected value with perfect information. When you add the two together, you will get the value of your perfect information. Then also we can have an imperfect information. Okay? So how do you get the value of imperfect information as well? Now, imperfect information is also the same thing like expected value without imperfect information and expected value with imperfect information. Add them together and you get your value for imperfect information. Now, imperfect information reduces. What is an imperfect information? Information that is not totally correct, that is not perfect. It can be correct, it can be wrong, right? But it can be reliable to an extent. Okay, that's it. Now, so imperfect information reduces, but does not eliminate uncertainty. Perfect information comes with certainty. Imperfect information will come with uncertainty no matter how much you try. So you calculate it similarly, but with perfect information, but more complex due to potential inaccuracies in your predictions. All right, that's for perfect and imperfect information. Any question from anyone? Before I go into simulation, I'll be rounding off with simulation tonight. Let me check. Simulation can be very wide. I will still have a payoff table. We are still under simulation though. Okay. Yes, any question before I go into simulation? Any question? Okay. Now, simulation is, I'll first read what is here and I'll explain to you. Now, simulation mimics real-world systems over time using models. Real-world system over time using models. Now, what does it mean in the layman's language? Simulation is representing or presenting what is going on in the world with figures. Presenting what is going on in the world with figures. Okay, so what do we mean by this? Now, a real fact, let's say one wanted to discuss coronavirus. Now, we can present coronavirus in figures and make it look like numbers. We can present coronavirus in numbers. That is simulation. Presenting world problems with figures, with numbers. That is simulation. Are we together, please?
Yes, sir.
That is simulation. Now, it helps us to analyze complex, uncertain, and interdependent systems. Complex, uncertain, and interdependent systems. It helps us to analyze it. Okay? Now, the process is that we have to build a model representing key system characteristics. Okay? A model representing key system characteristics. Then also, we introduce different variables and run it over time. Another thing next is that we run multiple simulations to identify average outcomes and trends. Simulation is very interesting. Like very, 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 very interesting. Do you understand? Very, very interesting. Now, how do we use simulation, or what do we use it for? We use simulation in inventory control. Okay? Now, when you want to control your inventory, what's an inventory? Stock, Abby? An item of stock, Abby?
Yes.
We use simulation to control inventory. We use it for capital budgeting, investment appraisal. We use it for queuing management. What is queuing management? When you go to the bank, you'll be on the queue, right? I don't know if people still go to ATM machines But before, there used to be queues on ATM machines, Abby, but not anymore. Or I don't know. Does anyone still go to the ATM machine?
Definitely.
Not really.
Yeah? What do you say?
I say not
Definitely.
really.
People see the ATM
People are
machine.
still going, but there is no queue like that
There is no
again.
queue again
That,
because who
that
cares? If they like, they should have money.
You go
If
to
they like, they should
POS
not
and
have
withdraw.
money. We have our, what's it called? We have our, this thing already, POS, right? So that's
Right.
it.
Exactly.
Now, we use it for queuing management when you go to the bank and you queue. Yes, we use simulation for that. Do you understand? We use simulation for it. Then also, when you want to do replacement of items, replacement of non-current assets, we also use queuing. We use simulation for it. And it helps us to evaluate outcomes under different scenarios and constraints. This thing is not feeling like PM, Abby. It feels like you are doing theory. Don't worry. When we get to the calculation part, you will see it. That is not just theory, right? And many of these things can actually be, they are simple though. They're very simple. So that's it. Now, Monte Carlo simulation. Monte Carlo simulation is a complex simulation. Okay? It's a complex simulation. And that complex simulation is that you can have multiple numbers. Okay? You can have random numbers. You make use of random numbers to model probability based outcomes. Okay, and they will give you the random numbers, they will give you the ranges of the random numbers to different outcomes. All right, the range for different outcomes, and you base it on cumulative probability. It's actually a very simple thing. Okay, so that's it. Then also you'll be using these random numbers to generate real life outcomes. With that random number, you will know what your sales, you actually use it to forecast sales. All right, so that's what we have there. Now, what again? And it is suitable for models with many interrelated variables like quantity, variable costs, fixed costs, prices, sales, and profit. You can use it, yes, you can use it like that. You can use it to get that. Now, I'm not using this. I'm not using this. Now, simulate. You can simulate many rounds to predict light travel. I'm not using that. Now, let's go into sensitivity analysis. Sensitivity analysis. Now, sensitivity analysis is called a what if analysis. Sensitivity analysis is called what? A what if analysis. Now, it is that analysis that permits you to think like a pessimist. You know who a pessimist is? A pessimist is someone, when we say someone is optimistic, someone who believes it go better in Niger spirit. I mean, it go better, it go better. But a pessimist is that person that will say that, what if it no come better? Am I right? Now, that pessimist that we have, all right, a pessimist will make use of what if analysis. So we call it a what if analysis in the sense that what if our sales, what if we are unable to sell as much quantity as we have budgeted, as we have forecasted? Also, what if our expenses increases, anything negative, okay? What if our profit is not that profit? What if we don't have up to that profit? That is always negative thought. So you can't say that what if your profit is better? Your profit cannot be better under sensitivity analysis. It cannot be better. It will get worse. That's what you mean by sensitivity. Okay? Now, those are the things. So it is a technique that evaluates how changes in key variables will affect your expected outcomes, such as profit. So what will make you not achieve this profit? Okay? So we use it to test how much a variable, when we say sales volume is that what if I don't sell up to this quantity? Okay? Or what if my expenses increases? What if my sales reduces? Okay? Then another thing is that what if my profit is not my profit? So we conduct the what if analysis and we use it to identify the most critical variables. What are those variables that will not allow you to achieve your objectives? That's the what if analysis. Okay? That's the what if analysis. Now, the process is that we start with the original estimate. They will give you the original information. You start with the original estimate. After starting with the original estimate, you will not change two variables at the same time, please. You will not change two variables at the same time. You can't do that. You cannot alter two variables at the same time, please. So your what if is that is either you alter sales or selling price. And when you are altering selling price, it means you are reducing it, because the only thing that will not make you achieve that profit you have is if your selling price reduces. All right? Another thing is if your cost price increases, you will not do the two at the same time. You alter one key variable at a time, and then you recalculate the expected outcome. So let's say my sales is 1 million. Now, what if let's say my selling price is 10 naira, which means I plan to sell 100,000 units, right? So if I plan to sell 100,000 units, let me bring in an Excel sheet. If I plan to sell 100,000 units, sorry, is someone there with me?
Yes, sir.
Yes, sir. We are with you,
Okay.
sir.
Yes, sir.
Selling price. So if my
Yes, sir.
plan is to sell, yes, sir. If my plan is to sell 100,000 units as 10 naira, that means I'll be getting 1 million naira, right? Now, what is that thing that will affect my selling price what is that thing that will happen to my selling price, and then I will be unable to achieve this 1 million? I can only achieve less than 1 million. It is only if my selling price reduces now.
Yes, sir.
Yes.
Okay? Now, what if my selling price reduces to 9 naira? Let's say we're having 1 million. So the first thing is that I'll first identify the initial variable, all right, which is 1 million. Now, the what if analysis will now be that what if this is not 1 million again? What if this is 9 naira? How much will I achieve? 900,000. That is the what if
900,000. Yes.
analysis. Or now that is A. Let's say B now says that what if your quantity reduces by 10%? You will not use this new figure of 900,000. No. You will come back to the original figure again, because you have to alter the alternatives one after the other. The two will not match at the same time. So you bring the original again and then say that at this 100,000 is at 90% times 90%, which is what? 90,000. No, let me use 95 so that I'm not using the same 900,000, 900,000. So what if my variable cost, my sales unit reduces by 5%? That means I'll be having 950,000. Those are the two things that will affect these sales. That is the what if analysis. Don't do the two of them together at the same time. No, you pick them a step at a time. Okay, are we there?
Yes, sir.
Shall we proceed, please?
Yes, sir.
Okay,
Ah,
don't worry, we are rounding off too. I'm not taking these payoff tables tonight. I'll close it at this what if analysis. So the essence of this sensitivity analysis is that number one, it helps us to assess uncertainty one after the other, and it is easy to implement when you are using a spreadsheet. Now, the limitation is that it depends on management's judgment, because how can I assume that my sales unit will reduce by 5%? Where did I get the information for? Is it the customers that told me that they will not buy 5% of my product? No. So which means it is subjective. It depends on management judgment. Then also, it doesn't show probability of changes occurring. It will not show the probability that, because I only said, what if my percentage, what if my sales reduces by 5%, right? But what was the probability that my sales will reduce by 5%? Did I bring that out? No. There is no probability. I just assumed. So it doesn't consider any probability. It doesn't show probability of the changes. It only shows the impact, that if it happens, what happened. All right? So that is that. Do you have any question, a closing question on everything we've said so far? Any closing question? In the absence of a question, I'll see you all in our next class.
Thank you.
Good
Thank
night,
you. Thank
everyone.
you. Thank you. Thank you so much.